influence from mere association. Like some management might have done something almost 8 9 years ago, so second generation might have come in and the business might have been transformed. So that thing is also there. If you talk to like some old timers, so they'll tell you some story that was 25 years ago, which might not be relevant right now. So that thing is also there. And one of the other appreciations that I've had over the years is this idea of authority bias. So when you get into investing, like when you just start investing, so you're always infatuated at what the other person is saying. And if the other person has a lot of experience in the markets, so you think that what the other person is doing might be right, or what he is saying might be very credible, which it will be credible. So they might have built their reputation over the years, but at the end, even that authority is dealing with something that is probabilistic, that is at the end investing in businesses. So this appreciation of authority bias and halo effect also came in eventually when I just so truth to be told, in the beginning I also like blindly cloned some of my mentors, and I just copied their investments, and I lost a lot of money at that point of time. So that appreciation also came in, like when you reflect back, then you realize that at the end it is your independent conviction and your independent reasoning. Even some of the people whom I've seen like subscribing to advisory services, they will not sell a stock when the advisory has suggested to sell a stock, right? Or they might buy a stock when the advisory has or they might buy a stock in a very high allocation when the advisory has suggested to buy a stock in a low allocation. So that those things also just come into play, that you fall for authority bias, that how this advisory can ever go wrong. But the truth of the matter is we live in a probabilistic world. So the appreciation of probabilities and this idea that there is no halo effect, or every human being can make a mistake over here, that has just started coming over a period of time. And the way Sanjay Bhattacharya keeps on saying that there is no right answer, there is only the right question. So I think that is a very deep statement. So I think as you go along in as you go along in your journey, you will also start finding these patterns play out over and over again.
Absolutely. That was a really interesting point that you raised. Hi, Ishmael. This is Krishna. So I have a follow up. So you spoke about all investing being probabilistic, right? And you've spoken in your videos that you follow a growth at a reasonable price investing strategy. So how does that compare to one where you're investing in monopoly businesses that are essential? Don't such businesses have a better competitive advantage over growth at a reasonable price?
See, some of these businesses, as I keep saying, that there are almost uh, thousands of ways to nirvana, right? And someone who's buying a proven winner already, they can just sit on it for maybe next 10 15 years, because if the competitive advantage sustains, so they might end up making returns. There is a very interesting concept of price to index ratios. So instead of price to earnings, if you look at price to index ratios, so that is also a very good concept that is borrowed from the book of Terry Smith. So recently read this book, Investing for Growth. So he talked about how a few companies always traded at a PE ratio that was double that of the index. Similarly, I was listening to the interview of Mr. Ramdev Agarwal when he said that he couldn't buy Asian Paints because it always used to have a PE ratio that was basically 2x of that of the index. So that was an interesting thing. But at the same time, there is also another line of perspective. See, purpose is to understand as many perspectives as one can, right? And then to frame your own frameworks, and then to follow your own frameworks. So I have a friend of mine. So basically, he bought Marico when Marico basically fell to a almost a price to earnings ratio of 38 to 40 times, right? And if you compare the performance of Marico as compared to a Dabur or a Godrej consumer, or in the FMCG basket that is basically linked to consumption, like a Dabur, a Godrej consumer, or such companies, so Marico has ended up outperforming the FMCG index in that case. So he had a different perspective, that basically he views market as a accumulation of different participants, that there are plenty of participants in the markets, and he is basically trying to view the business from the eyes of the different participants, that how are they thinking about this company. Do they think that the growth has gone away, and do you really think that the growth has gone away? So that difference of opinion on the cash flows that are about to come. So what happened in Marigo's case, that they guided for strong growth in the food business, and that growth started happening. Then it again got re-rated from that 40-45 p to almost 70-75 right now. So at 70-75 p, before it got derated, it used to be known as a coffee can. But when it fell to 35-40 p, then it wasn't known as a coffee can. So I think this perspective, or this idea of framing businesses into categories is a good idea. But any idea that one takes to a very extreme extent becomes bad as well at the like at the end. So I think you have to look at different perspectives. So there is no alternate solution to this to that. But my own perspective is that I basically like to make my portfolio of companies which already have. So basically, there is this concept of a pulley. So I have this framework of three pulley framework, which I've recently thought about. So that is basically, if I look at some of the biggest winners that we have had, is that all of them had three things in common. Initially, there was a cheapness in the multiple. Secondly, the ROC also expanded. And thirdly, they were triggers for earnings growth. So all the three pulleys pulling together in the same direction: P re-rating, earnings growth, and ROC expansion. Then there is also a second framework that I like to use, that there are some businesses, as you rightly mentioned, who have already won the race, right? And over there, PP might be already high, but the ROC is also very high, and the earnings growth will also likely sustain. So that is the second kind of framework which I use in my own portfolio. But truth to be told, do I own these stable companies or consumer companies in my portfolio right now? The answer is no. Even in the second type of framework, the companies that are there in the portfolio, they will likely grow at 20-25% the earnings. So because some of them have confirmed contracts for 7-8 years, and some of them are very strong capex backing. So I think that also makes it very interesting. And one very interesting concept is the quality of investor that comes into the company. Now, this is one concept which which I've basically started appreciating recently only. That if a foreigner or if a foreign institutional investor comes into a company, so he might have a different discount rate than what you have, right? So just as an example, I think Sahir owns this company by the name of Radico Khaitan, right? So Radico Khaitan till 2015, 2014 used to have a lot of debt on the balance sheet. So you won't expect Bharat Shah to come and ask questions in the con call way back in 2015, 2016, right? But now since the now since the company is deleveraging right now, and the debt is almost the company is coming to net debt free level, and the company is premiumizing its portfolio. Now you'll see investors like Bharat Shah coming to ask questions. And whenever big institutions come or they buy a stock, they're typically looking for certainty of cash flows, and certainty of cash flows, automatically they are coming with a lower discount rate. So one more example, so I think this is the concept of a DCF mindset, which we will talk about in this session. So I think I have plenty of examples for this as well. But I was just reading this company Sona Comstar, right? So just as a complete disclosure, I don't own the stock, but again over here growth is very certain. So they have close to 14,000 crores of order book right now, and the growth element is extremely certain right now. Now you look at the DCF assumption the analysts are using in their own reports. Analysts are assuming 7% terminal growth rate. Some analysts is using 6% terminal growth. Whenever terminal values assured in a business, that is typically when the valuations just go ballistic. This is what I've observed as well. Whenever cash flows become very certain.
Yeah.
Hey, yeah, another quick point. I think
extremely well made points, Ishmael. I'll just add to one of your points, which I kind of liked and I kind of caught on about the nature of investor which gets attracted to a certain kind of company or a certain kind of style of investing. I think you made a very interesting point on how you're trying to understand three, four, five, six extra aspects of how to look at style of investing. End of the day, every individual is different, and there's always going to be a slight adjustment as to how he wants to, or he or she wants to understand how they want to go about investing. uh, I think everyone has to find their own style, and as you rightly said, for insane companies like for the likes of Pidilite, stuff like that, you're going to have a few investors who are going to remain there for a while because the cash flows are pretty much certain to a large extent. So I just wanted to make a add to that interesting point you made on the observation about the kind of people that get attracted to a certain style of investing, which exactly has to be the how you are as a human, as in your everyday life, like the individual you are, you end up getting attracted to that similar kind of style of investing. Back to you, sir. Just wanted to add that point.
Yeah, I think Utkarsh wanted to circle back to biases. So biases. So yeah, go ahead, Utkarsh.
Yeah, yeah. So thanks a lot, Ishmoit, for coming on this platform. So you had mentioned about like first conclusion bias, right? And these kind of like first confirmation bias usually creates pockets of inefficiencies in the market. Like you said about the Deepak Knight, right? Uh, your first conclusion was that it's a commodity business, and later on people realize that it's much more than that. And we see these first conclusion bias play out uh, even market wide as well. Like for example, currently everyone like keeps saying about the PUCs that they're not worth investing, and they're not the wealth creators. So my question was more like based on your investment journey, what other like first conclusion bias that you had experienced, and how those later turned out? Were you right in your first conclusion bias, or were you proved wrong later on?
So I think that's a very interesting question. So I think, see, along with first conclusion bias, so there are plenty of these mental models. So mental model at the end is nothing but categorizing a few patterns that keep playing over and over again. So social proof again, along with first conclusion bias, or even social proof is a very interesting concept, which basically says that mostly people are right, and actually, it is the truth that if you look at even markets, more than 90% of the time people are right. This is why sometimes the deep value investing framework doesn't work. If you look at 10 deep value opportunities, out of them 8 or 9 do have some issue or the other. Some might have a corporate governance issue. Some might have a very big piece of land that is lying on the balance sheet. The other day, I think this happened almost 3 years ago. There was a business by the name of Mankasia, which used to trade below its cash in terms of the market value. Even today, it is trading below its cash, right? So, social proof is also a very interesting concept in investing. But one way to actually deal with first conclusion bias is actually the only learning which Charlie Munger keeps on repeating is that he tries to keep away people who basically who basically even they do not know the answer, but they want to answer something, right? So first thing is that you need to be humble enough. Second thing is, even if you have actually found an opportunity, so this is one trait which is very striking across some of the investors I've been in touch with. So one of them almost has had a 36-37% kgr for last 4 or 5 years. So whenever he wins big, he attributes it to luck, right? So that is also very interesting thing. And thirdly, to do away with first conclusion bias is to only speak when you know about what is happening. So once I did the research on Deepak Knight, right? Once I met the largest distributor of phenol, like he's basically based out of Delhi only. So that is when you start getting to know that why a particular company is getting into a particular product, right? So without getting to know the complete facts, I think it is extremely from what I've observed, it can actually lead to an act of omission. Because most of the times, if you look at these companies which give the highest possible returns, they are undergoing business transformations, right? So basically, they're becoming from a commodity company to a value-added company. So at these point of transformations, either you can go right or wrong. But if you go right, you tend to make a lot of money. But if you go wrong, so then again, that is a like that is again the probabilistic aspect of investing. But there is a very diverse opinion in such companies. So unless or until you're very sure about what you're talking about, until your reasoning is based on your own facts which you have observed, so I think you should not be influenced by someone else's opinion, or you should not be biased by your own previous biases, which might not hold true any longer.
Right, right, right. So I guess you're right on that. First, we should read and then conclude, not first conclude and, and then read. So that's a great point that you made.
Uh, yeah, go ahead, man, Ishmael.
Right, I was just agreeing with Utkarsh.
So yeah, guys. Before I guess I ask the next question, just wanted to give a quick reminder. Um, this session won't be recorded, so yeah, I guess you're not allowed to record this. Also, we're not SEBI registered advisors, and nothing said here is investment advice or financial advice. These are just examples that we're taking. So please not take any financial decisions based on what we say. Another quick reminder, please check out Ishmohit's website, and please check out his YouTube and Twitter, the SOIC YouTube and his Twitter, which is at Ishmohit1 and at SOIC Finance. And you won't regret it. It'll be a great, great decision if you haven't already. So my next question, Ishmohit, ties in with what you said about Manaxia and how it was trading below cash and companies like that. So how does one differentiate between deep value and a value trap? Like, what do you think are some key metrics to look at in differentiating them, and how would you uh, how would you know that something's actually a value trap versus it being actually something that's deep, deep, deep value?
Right. So I think first let's just try to understand this concept that why does something become a value trap, right? So again, I just tie it back to first principles, that is applying a DCF mindset. So if you do a discounted cash flow analysis, so the valuation of a stock is nothing but the present value of future cash flows, right? So once you're doing that, so there are three or four elements which go into it. First is the growth of cash flows. Second is the discount rate that you use, and third is the terminal value. If you start from the aspect of terminal value, so 70% of a stock's valuation is basically in the terminal value of a business. Will the business survive over a long period of time or not? Basically, in an essence, that is what it means. And if you look at the first aspect, that is growth of cash flows. So growth of cash flows, again, these are just quantitative criterias. At the end, the quantitative is tied up with qualitative, that how solid is the industry structure, is there any substitute good that is available. So those are the aspects on the those are the aspects on the business research. Now, just as an example, have you seen have you seen the stocks of businesses like HMVL or a DB Corp? So basically the entire newspaper basket. Now on the business front, you can basically make a reasonable assumption that the way news was consumed before through physical copies, that thing might not sustain any longer, right? So whenever there is a hit on the terminal value, that thing remains a value trap, because market won't value such a thing which doesn't have sustainability, which won't grow, which you're not even sure will survive after 10, 20 years. Most of these businesses, I think a year or two ago as well, used to have an ROE ROC of more than 50, 20%, right? So but the valuation just isn't there. They get a PE multiple of 2, 3, 4 times. Similarly, if you look at a business like ITC right now, see, the consumption of tobacco, it might have increased in India, like the consumption of cigarettes at a very slow pace, but globally already the consumption is declining. And the underperformance of cigarette companies or tobacco companies is not just an Indian phenomenon. If you look at these companies which are listed abroad as well, all of them have given almost last 7 8 years return of -4 -5%. Whenever there is a terminal value hit or whenever there are doubts on the terminal value, the thing ends up becoming a value trap. Now, ITC, some people might say that they will grow the FMCG business, they will do this, they will do that. So I think that still remains to be seen, because as a percentage of profits, that still won't be much, even if it grows 1 or 2x from here. That is something which has to be seen in the context. And secondly, there is also this concept of conglomerate discount. So Charlie Munger keeps on saying this very interesting thing that if you mix raisin with turds, you still won't eat the bowl of raisins, right? Because there is still a piece of turd inside. Similarly, in businesses which have a conglomerate structure, sometimes it works out, but sometimes what happens is that it ends up becoming a value trap again. One example over here. So this is one of my mistakes. So I think telling you more about my mistakes will make you learn more as compared to my successes, because thumping your successes is the easiest thing to do. So I used to be invested in this business by the name of Edelweiss, right? So I was there in this business way back in 2016, 2017, and this was one of my mistakes, right? I thought that this so there is an ARC business that has a 17 18% ROC, and there is an advisory business. So what else will happen? जो NBFC का business है, अगर थोड़े time डूब भी गया तो क्या होएगा? But the thing is that there is a conglomerate structure and something or the other really goes bad, or something is very deeply cyclical, and that thing is punished by the markets. I think that stock fell almost 85%, right? So luckily I got out at a drawdown of 40%. So there is this one rule which I have: कि if I am not convinced to add to a stock, if it draws down by 40 45%, so I just need to sell. Basically, I made a mistake. So that is appreciation of social proof, that if the entire market is okay and one sector is correcting badly and something has gone wrong, so you also need to basically accept the concept of social proof, that you might be wrong as well, right? That is what will make you survive in the long run. And one more concept of, I think, value traps is just the company has ran out of space to grow. So the concept of numeracy, or basically अभी इंडियन कॉन्टेक्स्ट में अगर आप बाहर की कंपनीज की एनुअल रिपोर्ट्स और कॉन कॉल्स पढ़ते हो, so you will find that in the conference calls, one of the primary questions asked by analysts, or one of the primary answers given by managements, I think Saket, I think he reads a lot of con calls abroad, is about total addressable market, that is TAM, right? So basically, managements give the entire basically calculation that this is our TAM and this is how long we can grow for, and this is our plans. But in Indian context, you have to find out TAM from different sources. So a company like, just to give you an example, it's a fantastic business, but a company like OCCL, maybe after this round of capex, if you just go and read the conference calls, they are again clearly saying that we do not have opportunities to grow. We do not want to diversify. We want to stay over here, which is a very good thing. With like, hats off to the management. But if I, as an analyst, am sitting, or if I, as a market participant, I'm doing a DCF, so I have to think about that this company might not grow for a very long period of time, right? And one of the other things about value traps is, or one of the other disastrous thing about a discounted cash flow analysis is, where most of the people go wrong, is that have you ever seen someone basically assuming a degrowth in cash flows? Have you ever seen an analyst report which assumes a degrowth in cash flows? Right. So this is a question for all the panel. If you have seen, so do tell me.
Yeah, fair enough, man. Thanks for sharing that. So I have a couple of questions. One with respect to what you said about ITC and the conglomerate and the raisins and turds example. So I guess in this example it makes sense with like ITC being a conglomerate. But what about like companies where there are multiple business segments? It's often believed that the valuation the business gets is of the worst big business segment. But for a company say like Polycab, maybe that was the case initially, that it was getting uh, rated it. I guess the perception was that it was a wires and cables player, but now I guess there's a uh, change coming in, that the perception is going to be of an upcoming FMEG player. So how do you spot these changes? And another question was with regards to your DCF mindset. Like, how do you look at do you look at macros at all in these for these mindsets, like say bond yields, interest rates, etc.? Because all these can impact discount rates a lot, right? So yeah, how do you look at these things?
Right. So, to the first question, I think, see, if a company is trying to get into a business adjacency, so I wouldn't necessarily call it that. So, and secondly, if you just think about the unit economics of a B2B business versus a B2C business, so there are some things which become extremely clear, that a B2B business has higher working capital days as compared to a B2C business which has lower working capital days. Secondly, if you look at the peers of Polycab who already have a B2C business, they've already displayed a successful story. And Polycab already has a distribution network well built. So at the end, you have to think about the business, that if they're getting into an adjacency, whether they'll be able to capture it successfully or not. So coming to this example of ITC again, so if you look at it, so there is an IT business, there is a hotel business. The agri business is actually good for them because it helps for backward integration. Then even in FMCG segments, there are products which have very low margins. And lastly, we have the cigarette business. But still, the multiple that is being ascribed to the business is that of a khichdi business, basically a consolidated structure. Whereas if you compare it with a polycab, over there the strategy seems to be very well defined. That distribution is already set out. If the B2C segment scales a lot, then you already have successful peers who have done that already. So that narrative can change over there. And if you look at the PE multiple of such companies, so that becomes very, very interesting to look at. So if you look at something like a Deepak Nitrite, so markets are extremely intelligent. So if you look at something like a Deepak Nitrite, when it was given a PE multiple of 10 times, Aarti Industries or these businesses like Vinidhi Organics used to get a PE multiple of 35 times. Aarti used to get a PE multiple of 25 times, I think almost. Now Deepak gets a PE multiple of 30 times. If I'm not mistaken, last I checked, 30 or 32 times. Aarti gets a PE multiple of 55 times. Vinidhi gets a PE multiple of 70 times, right? So what the market is trying to tell you through these multiples is that they think that businesses like Clean Science or Vinity, they are like, so since the sector is in flavor, because this is one of the reasons why I'm talking about it, is that these businesses have very high ROCs and these are the true blue specialty chemical companies. Then there are businesses which are one notch below them, which are your businesses like Aarti Industries, which have displayed consistent margins. And I think they report, if I'm not mistaken, 23-24% EBITDA margins. And they are going through a capex cycle. Then there is the last year of businesses which are bulk chemicals which get 10 or 11 PE, like your Bodil Chemicals or all these companies. Then there is a Deepak Nitrite which gets a multiple between a bulk chemical player and a business like Aarti Industries. So this is where you basically make your mind up and you think that if you get the facts right, if they incrementally, if they're going into downstream derivatives, and if they're able to basically uh, dealing their margins from the underlying commodity, then it can become very interesting. But at these multiples, we are basically betting for perfect execution. But at a multiple of 10, 15 times, at that point of time, basically market is implying that they do not think that is the case. So you always have to get the future right, that where is the capital going. In ITC's case, I didn't have that clarity for almost 7, 8 years. Neither did anyone else. Only last year they came out with a capital allocation policy. So let's see what happens. But also, if you just talk to some of the old ITC employees, so they also have something like they have few very interesting insights as well. So point is that multiples do not exist in isolation. So you're basically never right because you think that a PE multiple is low or a PE multiple is high. You have to go behind the reasons. You have to basically peel the layers behind the reasons. That is only where opportunities also exist.
Thanks, Ishmohit. Thanks a lot. So, a quick question, like going behind the reasons. So, about PE re-ratings. and variant perception playing out? What are some of the reasons behind that happening?
I think that's a very good question. So I'm also just still learning through my journey. So I can just share my own case studies because that is the best bit I have to share with you. And I'll also share that when it goes wrong as well, right? So I think you also deserve to know when it goes wrong. So some of the examples. So let me give you this example. I've given this example, I think, plenty of times. Is this business that is APL Apollo, right? So a discerning investor who basically can gauge the second, third, and fourth order consequences of what happens when a business reduces working capital. So let's just think about this way. So एक business के अंदर जो एक invested capital है or the capital employed in a business, the core capital employed in a business is either in fixed assets or your working capital, right? Now, if I through some reason, if I basically switch to a cash and carry model, if I bring my working capital days down from 28 to 30 days to almost 7 to 8 days, what ends up happening is that my working capital requirement decreases. This is a first order consequence. Second order consequence is when we do the calculation of ROC, the calculation is EBIT upon fixed assets plus working capital. I'm just talking about core capital employed in a business. So if my denominator reduces, the second order consequence is my ROC goes up. Now the third order consequence of this event, third order consequence of this event is that if I do not need too much of working capital now, if my balance sheet has become lighter, I will end up deleveraging because I was dependent on short-term loans earlier. So that is the third order consequence, that my debt to equity ends up falling. And what is the fourth order consequence? That my cash flow from operations improve. Cash flow generation ends up improving. And if my working capital is taken care of, if my working capital needs have reduced, I end up becoming a free cash flow machine, which has happened also in the case of Radico Khaitan, where net working capital days have fallen from 66 days to 33 days. Right? And management throughout its last 2-3 years of conference calls has been guiding for the same. And the result is, I think, visible for all. I think this company will again end up becoming a free cash flow machine. I don't own the stock, but just an interesting observation. Second way where variant perception ends up working is that companies basically suppose you own a shop, right? So you own a shop and you sell a product which has a margin of 20%. Now tomorrow you come up with a better product. Now you're trying to basically market that product, and it is also being seen in the sales. And if you just guide that, so if you just and if it starts showing up in the margins that this product, the new product, has 30% margins, so that is where incrementally the direction of your margins are going. Sometimes the street misses this as well. Sometimes it is missed because you're thinking what will the business look like 2-3 years forward, right? So an example over here, I don't own the business already. It's at a super expensive multiple right now, but some of the other examples as well. So one example over here is a business. So it is already priced in. So I'll also give you an example of a business where it isn't priced in and where it used to not be priced in. And so one first, let's start with a super expensive example is that of a Sona Comstar. So the products that they're making for electric vehicle, so operating leverage is yet to play out, and current EBITDA margin from 28% can end up going to 31-32%, 3-4 years down the line. Secondly, if you look at a business like Garware Technical Fibers, since 2013-2014, it's been printed in the credit ratings almost for last 7 years. I think all of you can do this homework for since 2015. If you just read the credit ratings, it's been printed that the company's letting go of commodity products and it is entering into value added products, right? And you can see the impact on gross margins of what is happening, and then you can see the impact on operating margins as well, right? Similarly, you will see this happening in a business by the name of Indoco Remedies. It has already started happening, right? So this business had capacity built up, then there were some regulatory issues. Now capacity utilization is 60-65%. Now just imagine the such is the conservativeness of the management. Last year they guided for 14% margins, but they ended up doing 19%. And this company is guiding for a 500 crore of like a 500 crore operating profit in FY24. Currently, it is at 260 crores. So basically, a doubler from here in terms of operating profits. And it trades at a EBITDA multiple of almost 16 to 17 times, whereas a domestic pharma company. So one appreciation that you can also get is that that what is the multiple at which the peers trade at. Because if the business has a similar mix, so sooner or later it has, like I have usually observed, if the business has a similar mix, sooner or later the multiple which the business trades at gets to the same level. So this business again could be, again this is a variant perception from my side. So we got in at 3,000 crore market cap. So I do think this business could have a 10,000 crore market cap, because all domestic pharma companies are trading at 20x uh, EBITDA multiple, right? So they have an export component, and they also have a domestic business. So only today only they reported a 33% year on year growth because of low base effect, but Q2 can be extremely strong. But again, this is a type of investing where you have to take a horizon of next 2 to 3 years, right? So you're basically betting on numbers coming in next 2 to 3 years. So this is the variant perception which you can have over here. One more example of variant perception is this business by the name of Balakrishna Industry. So this one is also very interesting. So this business is at the end linked to agri cycle, that is agriculture cycle, because they sell tires to the so basically 60% of their cycle tires are almost sold to farmers, or at the end it is linked to agri. So whenever the global agri demand goes through a down cycle, just do this homework again. You'll see. So basically their volumes become flat. They also start degrowing, and at these point of time, you see reports coming from brokerages like ICICI or a Macquarie, which give target prices which are 30-40% lesser. So all of us end up forgetting that this is shallow cyclical business, because at the end there is some cyclicality in the demand as well. So this is also ends up becoming a so this also ends up becoming an example of variant perception, where you know that the demand might pick up sometime or the other, but the multiple it is priced at as compared to historically what it used to trade at. So participants are thinking that that isn't likely to happen. Now one person who does this beautifully when in terms of timing these cycles is I think he's also there on Twitter by the name of by the name of Jitin Parmar. So I think he's from Aurum Capital, and that guy has timed so many of these cycles, so it's like almost unreal to think of the amount of cyclicals he's been able to get into. Recent one was I saw his presentation on torrent on I think torrent power, sorry, TD power, where he was like almost a year ago, where he was talking about almost 6 or 7 months ago, I think last to last IIC, where he was talking about that how the like capacity utilization can pick up and how the order backlog is less right now, and those things have already started playing out right now. So that is also very interesting to see. One more tool of variant perception you can use is that when the management is actively guiding for deleveraging, that they are going to deleverage the balance sheet, that is again making your balance sheet lighter. And when the management is saying, or you have to actually see whether that is happening or not, because management can say a lot of things, but at the end the proof is in the pudding, right? So HCG is one of those companies, HCG Hospital. So I think the recent decision to sell Strands was good one, because I think that was a non-core diversification. So that ends up reducing the debt by 83 crores. Now here are some telltale signs which you can also use. So a PE fund came into the business, and PE funds usually have a very stringent exit criteria in mind as well. Now they are driving the capital allocation. The capex has fallen almost close to zero now. And again, this idea of understanding your circle of competence in hospital businesses, what has usually worked is that this is a cyclical business. You have to understand the nature of the business. So this involves a bit of work. I think almost if you just read 4 or 5 players in the industry, you start understanding this. And hospitals typically make money when the capex goes to zero and the utilization starts increasing. So similarly, in SCG's case, they are actively guiding for deleveraging, for turning free cash flow positive, and for basically reporting positive PAT. So just by this sale of Strands, they've been able to reduce debt by almost 83 crores in one go. So this company again might break even. So this is a turnaround type of investing, which might be difficult, and I can also go wrong. So that conviction reflects in the position sizing as well. But these are some of the like sources of variant perception that you can use as well. One more as well that you can use. So I talked about this idea of certainty of cash flows. So one more case study that we can discuss is that of a Heikel. So I think case studies are the best way to learn investing, because if I just talk about that Peter Lynch did that or Phil Fisher did that, so that might not be relevant to the Indian context. So this case study of Heikel, so 2018, 2019, the story has been known that if you just go read the conference calls, if you just go read the annual reports, so this business has always had an impeccable track record when it comes to US FDA. So almost 2 decades of no observations or no adverse observations from US FDA. So regulatory wise, it is clean. But for some reason, execution wasn't always there. But they announced a leg of brownfield capex. So all the capex that they did for last 15 years was greenfield capex. So their asset turns were generally 1x in a greenfield capex. Basically, 1 rupees ka asset mein 1 rupees ka sale ho raha hai. But this time in 2018, 2019, when they announced the capex, so they basically said that the asset turns will be 1.5x. And secondly, in the reactors, so basically these APIs are made in reactors, which HLE and GMM Fowler give like give to them. So basically, they said that in the reactors we'll be changing the product mix. That basically we'll be getting into higher margin products. And thirdly, again and again they mentioned in the con calls as well that this capex will be likely there will be some long term contract announcements as well. So in last two years of conference calls, I think Sajal sir also got the answer out of them very cleverly that this will be the business, that how it will look like, that how it will look like in 2025. It will have a 20-25% EBITDA margin and a 20% ROC. So that is the blueprint that was visible. But markets weren't confident because there was a good reason not to be confident, because execution was lethargic. But just by one contract announcement, you can just create a pattern recognition thing with Naveen, and what happened in Naveen's case and Heikel's case. That sector is already going through tailwinds. And just by one contract announcement and just by improving those disclosure norms, because this company had poor disclosures, you get disproportionate outcomes because story is very, very visible in such cases. So again, you have to be open to ideas, open to opinions. You need to have a probabilistic mindset, and these are some of the way, like if you really want to make disproportionate returns, these are some of the sources of variant perception. Again, coming to this example of music streaming, right? So Saregama used to be, I think even 2 years ago, when I read the business, I also think that this is all because of that product. I think Karma or Caravan, the name of that music product. So even I never knew that there is a music streaming business inside. So here your network of friends also comes in. If you have a good network of friends, if you can research with a lot of people, so they can also tell you that actually something is changing in the business. This there is actually a very profitable business that is hidden underneath, which has a ROC of more than 40-50%, and the incremental capital is just flowing over there, right? That also becomes very, very interesting to see. So you are looking for catalysts, you're looking for product mix change, you're looking for capex announcements, you're looking for management changes, you're looking for PE. So this is also one very underappreciated tool, that if a PE fund comes in, right? So one more example, SL Propack, fantastic business. More than so I think they have this monopoly in so basically, they have a lot of patents in the packaging of or the packaging of toothpaste. I think so. They make all the tubes for that. But the business was historically mismanaged by the SL group. They got into infra loan and everything. But Blackstone came in. Blackstone acquired the company, and ever since then, it's almost been a 2-3 bagger. Potential was always there. So in Indian context, if the management is changing, that can also become a very interesting trigger like in the current times.
So, Ishmohit, you spoke about different tools like margin expansion, deleveraging, the industry cycle, capex, I guess, management changing. Uh, would you say all of these are equally important, or some actually play out better than others? What's your opinion like on the same?
I think see the truth of the matter is that each and every variable has its own importance. Sometimes there will be some companies who might not grow the top line that much. So again, a company which I haven't invested in because of corporate governance issues is the sister company of Garwale, that is Garwale Polyester. There are a lot of related party transactions over there. So I haven't invested over there because I also need to sleep peacefully at night. So over there, the top line won't grow much, but the margins have already started expanding, or they have expanded because they're getting into value added products, right? So each and every company might have a different frame of mind, and I think you have to assess every opportunity with a different frame of mind. As I think I posted today in the morning only on Twitter, that as Bruce Lee says, that you have to be like water, right? So water, you put it in a bottle, so water becomes the bottle. Water, you put it in the cup, so water becomes the cup. So that is how your framework should be, that you have these key variables in mind, and you're thinking that how the future of this business can be different. Now it involves a lot of bottoms up business analysis, but even if you get it right for 5 6 businesses, your returns are taken care, are taken care of mostly. And I think it is also a function of which type of markets are we in. So sometimes so it is also, if a batsman is on a pitch that is meant for bowlers, right? So it becomes difficult for the batsman to basically hit sixes or hit fours. And sometimes even if you look at the runs that are scored in that particular match, might be less. So sometimes what ends up happening is that markets actually becomes like the overall. So in terms of finding opportunities, sometimes even the markets end up becoming expensive. So that is not to say that you stop finding such opportunities. You keep finding them, but sometimes you find like plenty of them. So that is just the case with the environment as well.
Uh, Thanks for that, Ishmoit. Thanks for those insights. So, guys, quick announcement. Krishna is going to go next, but quick announcement before that. Uh, yeah, please check out Ishmoit's website, soic.in, and check out his YouTube channel, School of Intrinsic Compounding. Check him out on Twitter at Ishmohit1, and his SOIC Twitter as well. So yeah, again, this is not a paid promotion, nothing of the sort. I'm not promoting him. I genuinely believe and love what he does, and so do a lot of other people. And the number of people we have here today is a testament to that. So yeah, please check his website out. Reach out to him if I guess you're interested in any of his courses. He has a very good course called the Intensive Program, and I personally have bought or enrolled myself in that, and I have benefited greatly from that. Even though I do this full time, there's something for everyone, from a beginner to an advanced. Again, like this is straight from the heart. Like this isn't a promotion or anything, but you will benefit a lot if you're interested. Check it out. Check it out. And so yeah, before, I haven't done this today, but please follow Investors India. We keep trying to do these sessions. Hit the greenhouse above, hit the follow button, and please follow the mods on Twitter as well. We work very hard. Um, Saket, Utkarsh, Karn, Krishna, Vishal, and Ishmo. It's new to Twitter, so give him I mean, new to Clubhouse, so give him a follow as well. So yeah, I just want to get that message out. And yeah, disclaimer: nothing said here is a recommendation or financial advice. So yeah, sorry, Krishna, go ahead, man.
No man, I think that was needed. Also, yeah, not sponsored at all. I'm also a member of Ishmoit's course. It's an absolutely amazing way to get yourself educated as an investor. I think even when Ishmoit's not in the room, whenever people ask like how to build up their understanding, we always mention that SOIC is a place to go to. Um, but yeah, to sort of pivot back a little bit, we were speaking about total addressable market, and I think total addressable market is very interesting when we talk about these unprofitable and new age companies, or companies that have just turned profitable but are in the quasi tech space, and therefore are able to give you this massive total addressable market. Ishmoet, I wanted to get your opinion on what is more important in companies like that, the size of opportunity or the potential revenue growth over the next 3 years?
I think both of them play together only because, like in such companies, the multiples that they come at, or the valuation at which they IPO, So basically, you're betting that they'll keep hyperscaling, whether it's next 3 years, 4 years, or a decade out, right? So I think both of them have a role to play together in that aspect. So, but sometimes you also have to have your like, uh, so I like to call this the bullshit filter on as well, because you need to understand that where the business model is going, right? So if you cannot answer a question that why is policy bazaar entering the insurance brokerage business, or if you cannot basically answer this question that what are the multiples at which Zomato's international peers trade at, and what has happened abroad. So taking a leap of faith in such businesses might become risky as well, because see, problem is that in Indian context we have very few such businesses that are listed. So there is always this element of scarcity premium, or if some institution has to allocate to internet sector, so hardly there are 7 8 companies that are there in internet sector. If an institution has this mandate that you have to allocate to platform businesses in India, how many are there? Right, hardly 6 7 8, right? So those things also end up playing in multiples as well. But I think if you look at these businesses abroad, so abroad if you look at businesses, so something like a Shopify, or the entire trend of SaaS businesses, which started abroad. So these companies came out with IPOs where price to sales were 15 to 20 times, right? But they had this very strong mental model going for them, which a lot of these Indian companies do not have right now. So I'm very open to opportunities. So again, no first conclusion biases, but this is an element which comes from Michael Porter's five forces. So recently, I was having a conversation with a friend who was talking about Root Mobile and everything. But if you read Twilio abroad, and if you read the CPaaS industry abroad as well, you get this understanding that if you apply this Michael Porter's five forces, then the bargaining power of suppliers is just immense, right? And because telecom companies, beyond a point, they will stop giving you discounts in the terms of the number of SMSs that you're purchasing or the type that you have. So your gross margins do not expand as your revenue grows. But the companies that have been listed abroad, so I think if you look at some of those companies, so what ends up happening is that your top line grows, and after a point of time, economy of scale kicks in, because cost उतना बढ़ेगा नहीं, top line बढ़ते जा रहे हैं, तो your gross margin just expands disproportionately. वैसा अभी एग्जाम्पल इंडियन कॉन्टेक्स्ट में आई एम स्टिल स्ट्रगलिंग टू फाइंड. So we have to see that if such a company gets listed, and what type of multiple that gets rewarded. But one thing is for sure, it is like extremely good that we are seeing the breadth of the Indian markets being widened, because all these commodity companies or all these manufacturing businesses or banking and financial, we need this kind of breadth in the market, because 10, 20, 25 years down the line, such companies will be dominating the fray, and you have to just stay open for opportunities, and you have need to have this idea of total addressable market at the same time. So just be open, read these businesses, and currently I haven't found in the new IPOs if there is a good like sort of opportunity. So this is just my opinion. So either it's a Zomato or a Policy Bazaar. So I'm just struggling to find that type of disproportionate growth to justify those valuations.
Absolutely. I wanted to ask you a little bit more about